Welcome to Crossing the Line, where we dig into the latest news on the economy, housing, and anything else that interests me. I'm Greg Heym, chief economist at Brown Harris Stevens, and apparently would pass for a podcast host these days, and author of The Line, a weekly economics blog with over 2,500 satisfied subscribers. Our goal is always to be informative, concise, entertaining, and edgy all at the same time. Let's see if we can pull that off today. Thanks for joining us. We're coming to you here from Studio 1873 at 445 Park, which is conveniently located right outside my office, Hannah. It's almost like they knew.
They did.
No, they didn't. But, we'll go with that. So we thought since the first episode, we'll talk just a little bit about the history of the blog. We started in July of 2020. And
do you remember what was on the first edition of The Line? You've written quite a few.
188 so far, counting last week. We actually tracked them. I didn't, but I looked it up. And the irony of the whole thing, it was a piece about mortgage rates falling below 3% for the first time ever. It seems like so long ago, but a little over 3 years ago, we were excited about that. Now rates are, 2.5 times that, and nobody's happy. We've covered everything in this time from jobs reports, Fed decisions, and mortgage rates, which we'll be talking about today, to every Met fan's favorite holiday, Bobby Bonilla Day, and how that's really due to Bernie Madoff. It's a really great story. Maybe we'll tell it one time. We talked about even people like West Montgomery and the government giving away free lighthouses. So who knows? You may be able to get yourself a lighthouse.
That'd be nice.
I know Hannah wants one. Who doesn't?
Of course.
Apparently the upkeep, though, is really expensive. And for some reason, the taxes, I don't know what income they generate, but, that could be rough. So the blog has been very popular, and then people kept saying, when are you going to do a podcast? And when is now? And I'm very excited about this as we have more time to dig in deeper. Those of you that have seen me speak live or know me know that I prefer to just wing it off the cuff. And now the editors can't stop me.
Right.
We have editors that proof this, make sure I don't abuse the English language. I can abuse it all I want here, and there's only Ray can stop us. Actually, let's introduce the team we have here. You've heard me mention Hannah, who is a copywriter and content strategist here, and working with our content manager, Alex, edits The Line every week. We have Lena, who's one of our producers. I guess that was a quick way to say it. All right, let's not complicate it. And then we have my old buddy Ray, Mike.
Hey everyone.
As Jim Croce would say, my what is it? Good, best old ex-friend Ray or something like that in that song. He's the other producer and the ones who better make it so I look really, good.
Camera ready.
Yeah, well.
Polished and beautiful.
Yeah. So anyhow, now that we're rambling on, in an ongoing effort to be brief, which is really something every economist has to do because your audience will only give you about 5 seconds before they tune you out. We're going to set sort of a time limit on each topic, and then we can always add. We want to kind of get you in and out in a reasonable amount of time. So let's hit with the first topic. What's first on the agenda today, Hannah?
The October jobs report.
Yeah, so I'm sure everybody's really heard about this, but to sum it up, 150,000 jobs were created last month. That was lower than forecasted. Dow Jones was looking for about 170, some forecasts even higher than that. The unemployment rate ticked up to 3.9% from 3.8%, still incredibly low. One sign to pay attention to that a lot of people don't really look at is the prior month's data are revised, and the data for August and September was revised down by 101,000, so that's a significant revision. The positive bit of news from an economy standpoint is that wages are still rising faster than inflation for now, although not as fast as they were.
Well, what about the labor market? Is it softening?
Well, a lot of the headlines focused on that, and I would say I hope so, because it's the only thing that's going to get mortgage rates down. People say, well, why aren't they coming down? Inflation has come down. The Fed has hiked rates more than it has in decades. We're having all this pain. Mortgage rates are near 8%. Remember that long-term rates, 10-year treasuries, 30-year mortgages, are really based on the future. If I'm going to lend Ray money, and I don't know that I do that, but if I was going to lend Ray money, depending on how long he was going to take to pay it back, I would want to charge a higher interest rate if I expected the economy to grow. And one of the things that's been happening most of this year is the economy's been outperforming expectations. At the beginning of the year, we thought we'd be in recession by now. Mortgage rates were coming down. Then as the data got stronger and third quarter GDP was the highest since the end of 21. So it doesn't seem like the labor market's been cooperating. So you can look at the job growth, much less than the prior month, less than expected. But on the other hand, we still have 9.6 million open jobs out there. Now, having open jobs doesn't mean much until people actually take those jobs. And that has been a constant problem during this, in the wake of the aftermath of the pandemic, where people, a lot of them have not re-entered the workforce yet. The labor force participation rate, which is the percentage of working age people like us, that are actually either working or looking for work. And that hasn't really gotten back to its pre-pandemic level yet. The other thing is unemployment claims are still very low. The latest number we have is 217,000. That's historically very low. So as much as you hear about layoffs at large tech companies, and as much as people may be worried about that, layoffs are really not showing in the data yet. The good news is the weaker than expected job report was great for stocks. Dow shot up big on Friday. And last week was the best week stocks have had all this year. And I said this before, on Vince Rocco's podcast. By the way, we don't have any swag yet for our show. So we're using as much Vince Rocco swag as we could get our hands on. Thanks, Vince. I even have the Vince Rocco notepad.
I'm just waiting for my T-shirt.
I don't know. Well, we'll see. Vince films his stuff here. Actually, I do call it the Vince Rocco studio. And when I told him I was having a podcast, he said, "What are you going to call it?" And I said, the Not Vince Rocco podcast.
Fitting.
Just to plug him some more. All right, that's it. No more mentions of Vince for a while. He better plug me on his show, or else.
Well, do you want to talk a little bit more about the Fed decision? I know you love to talk about the Fed.
All right. So how do we do on time on that one? Good. Yeah. All right. We beat the 10-minute mark. We were trying to keep it on. So yeah, this is what we like to call the rant of the week. I just made that up, but those of you that read the column know that I really target the Fed. And I have two pictures behind me here. One of them is Mark Messier, Rangers legend, and the man who saved a lot of us Ranger fans from just a lifetime of frustration and losing, and Alfred E. Newman. And I have a picture of Alfred E. Newman that my good friend Sandy Wilson gave me in my office because, his Hannah doesn't know this, but his slogan was, "What me worry." Hannah's like, "I totally know this. Why are you looking at me like that?" I have to make jokes like this. And I used to always say, like, is Jerome Powell's monetary policy the what me worry monetary? Like, let's just all go to bed and hope it's okay in the morning. So they had a meeting. They announced that they were not going to hike rates again. It's the third time in the last 4 meetings that they've punted, so to speak. And I made a joke in last week's column that they are punting more than the Jets and the Giants these days. I don't know what they're thinking. The favorite measure of inflation of the Fed is what's called the core PCE, or personal consumption expenditures. Core always means you're taking out food and energy prices. That's been rising at a 3.7% annual rate, almost double their 2% target. So why are they stopping now? They expect, well, that's like saying, Ray, that that arm doesn't look so good, but let's just hope it gets better. And even though we know we're going to have to set it because it's broken, we're just going to wait and hope you don't come back or something like that. I don't understand it. If you were going to, and they said in their economic projections in September that they expected one more rate hike. What are you waiting for? Signs that the economy is really slowing down and inflation hasn't come down fast enough for you? Do it now while the economy is strong. Do not wait. It doesn't make any sense to me. But why does this surprise me? Because they've always been behind the curve. They have been late on everything. And, I was taking a walk down line memory lane. We asked a question about the first line. And our 1-year anniversary was in July of 2021. And I was looking at it because people go, "Oh, Greg, it's great for you to slam the Fed for being late to start hiking rates. That's Monday morning quarterbacking." And as a Jet fan, I'm very well familiar with Monday morning quarterbacking. But this was from July, and I went on a rant about how the chairman was saying that inflation is transitory. That was the word we were hearing in 2021. But what really upsets me and some other economists is they don't talk about the money supply. We could talk about rates all we want, but why aren't we looking at the money supply? Inflation is too much money chasing not enough goods. And people say we had a shortage of goods during COVID. We would have had runaway inflation even without that. You can't increase the money supply by 40% and just expect that everything's going to work its way out. Especially, when you're sending checks to people. That's the difference between now and what happened in the financial crisis. Then we gave the money to the banks. So I even closed that piece by saying this inflation data combined with increasing good news on the jobs front all highlight the need to taper Fed's assets purchases and start bringing up rates slowly. Or as Archie Bell and the Drells would say, they need to do the tighten up. Now, maybe Ray gets that reference. I may be the only one who does. It was a song called The Tighten Up. It was really cool, very catchy.
I think my question is, Greg, do you ever get tired of slamming the Fed?
They don't seem to get tired of aggravating me, so why should I look, as an thanks, Ray. It's our first clap. Lena, you're not clapping. I don't know. I don't know. Look, it gives economists a bad name, even though Jerome Powell's not an economist. I think the problem is the Fed they have a dual mandate. Their only job should be to keep inflation at bay. Just like on Game of Thrones, they have the Night's Watch that keep the dead at bay. We can't let them in because that would be terrible. But instead, they have a dual mandate to also maximize economic growth and employment. They shouldn't be worried about that. They're supposed to be the adults in the room, but yet they always let rates get too low and keep them too low for too long, which then leads to speculation. And that leads to stock market crashes. Because as Ray was reminding me the other day, the number one cause of recessions in the United States is bad Fed policy. So I don't like anybody giving economists a bad name. I want to be the one to do that if anybody does that. But, it's frustrating. You always have to think about the money supply. And Hannah, since you probably don't know this, money was this green folding stuff you had, and you kept in your wallet or your purse. And you
the time when cash was king.
Right. Before Venmo and Apple Pay. And I use Apple Pay all the time. I'm not that old and square yet. But it's a simple thing. And unfortunately, I don't think our last couple of Fed chairmen have really gotten that. They need to go back and read more Milton Friedman because he is the father of monetary economics. So, no, I'm not going to get tired of calling it out. This is where we cross the line. People go,
We've done it.
Now I don't know if I've crossed the line. I haven't said anything about, anybody's family like that. So I think we're okay in that. I just think that as an industry, we're frustrated. NAR and a couple of other real estate organizations sent Chairman Powell a letter a couple of weeks ago asking him to stop raising rates. His response to them should have been, I can't worry about that mortgage rates are too high because inflation is like termites in the house. You have them in your house, everything else waits. You're not going to redo the kitchen when you got termites eating through your house. So he has to worry about that and nothing else. So I think that's why we really should have them singly focused in keeping price stability. And they're not doing that. And Americans have paid the price because as much as you look at a great, hiring figures, there's a lot of jobs out there, you look at a low unemployment rate. But with all of that, when they ask people about their moods of the economy, most people have a negative, feeling about the economy. And it's because prices are too high. Jimmy McMillan was right. Remember the guy that ran for mayor of New York City? The rent is too damn high. He had it right. All right, so that's how we do on time on that one, Lena.
We're good. You got 15 minutes.
See? All right, great. It gives us time to do pregame for the Jets tonight. So we actually wanted to have what we're calling a bullet round. I don't know. If someone comes up with a better name for it, please send it in and let us know. This is kind of a speed round kind of thing, or to use up extra time we have. Although we could stop right now, but trust me.
Why would we do that?
I don't know. It's not lunchtime
We got to keep it going.
I'm having fun. I don't know. You having fun, Lena?
Oh, yeah.
Ray?
I'm having a blast.
It's good to have another old guy in here who is follically challenged. I have to say, well, you're not on camera. Don't worry about it, Ray. I'm the face of this thing, and Hannah, you having a good time?
I'm having a great time.
Okay, well, I haven't abused you enough yet, but we'll get to that. So,
Yay.
what's number one on the bullet round here?
Well, we could talk a little bit about mortgage rates.
Well, lately I don't like to talk about them because it depresses people.
Right.
But there was slightly good news. For the first time after 7 straight increases, mortgage rates dipped a little bit last week. The better news than that is that after the jobs report, immediately 10-year Treasury rates started to go down, because again, it's showing that maybe the economy's cooling. Wall Street and markets are usually either way too happy or way too scared. In this case, they're very happy. People said it's just the jobs report we're looking for, unlike the droids we're looking for in Star Wars. Are you a Star Wars fan?
Of course.
Okay, good. I'm not
course.
the biggest one. I want to make sure I get my references correct. But, it's going to take time. The only thing that really gets mortgage rates down very quickly are recessions. We don't necessarily want that. We're all praying for that soft landing that we keep hearing about. And what that really means is when the Fed slows the economy just enough to break the back of inflation without putting us in recession. So that's really all we can say about it. It was good that it went down. Rates didn't go down a lot. Demand for adjustable rate mortgages is still very strong for that reason. But who knows? We'll know a lot more next week when the consumer price index data comes out. What's next?
The lawsuit.
Yeah, so I'm sure everybody's heard by now about the National Association of Realtors and a lot of brokerages losing a $1.8 billion lawsuit in Kansas City, and then being served literally right after that, a bigger national class action suit, basically talking about commissions and overcharging commissions. Look, someone's going to do a much better podcast on this, and it would take all of our time to do it. Basically the commission structure has been in place for as long as any of us can remember, but I think some people are concerned with that, may think they're too high. Commissions are higher here than other places. I don't want to argue on the merits of the case. Again, it would take too long, but it leads me to another sort of rant. And, real estate has an image problem. We've had one for a while, and we've seen it manifest in some of the legislation right here in New York, attempt to cap broker commissions. We hear all the time how they're overpaid. They just take 6% of the sale and they don't really do much for it. Or as Bess Friedman likes to say, they watch, these reality shows and they're like, oh, that guy worked 5 minutes and got a $10 million deal. That's not true. And I think we as an industry need to do a better job of educating people in terms of what real estate brokers do and how hard they work. And there's never a guarantee of making any money when they work with a buyer for several years and the buyer decides they're not going to do anything. Right. Or, they represent a seller and the house languishes on the market. So I think that real estate has to remind people that they work hard and it is not just this simple thing, particularly here in New York where you have co-op board packages and rules and a lot of things that go on. And, how that commission structure works, all that stuff is always up for negotiation. So we'll watch this. I mean, this could literally, the $1.8 billion that was just ordered to be paid, that's peanuts compared to what a national class action suit would mean. And a lot of the national firms have been brought into this. So I think that we really need to have our voices heard. Another thing that we need to do is educate our clients better, not just when it comes to commissions. We wrote in the line a couple of weeks ago about a survey done when they asked potential home buyers, how low would the mortgage rate have to get for you to actually buy something? And they said 5.5%. And you ask, why is that? And they said, well, that's what mortgage rates have averaged typically. And it's not true. Over the last half century, 30-year conforming mortgage rates have averaged almost 8%. Now, we've been spoiled the last couple of decades with low interest rates. But I think, again, that's where we have to use our voice and shows like this and blogs and for you brokers out there, material you send out and remind people that, first of all, this isn't unprecedented. Second of all, you can have a healthy real estate market when you have high rates. And there's always the chance to refinance, which is good. So we have to work. We have to do a little bit better. Hopefully here on Crossing the Line, when we're not crossing the line, we can actually offer some helpful tips and point out some things.
Yes.
I'm not paying you extra to clap, right? In fact, I'm not paying you at all. What's next, Hannah?
Well, Susie Orman said a little something about Americans and if they're financially literate or not. So Want to talk about that?
Sure. Since I just knocked his head, this is my Ron Givry bobblehead, one of my prized possessions. And, I look for him for inspiration. He was my childhood hero growing up. I couldn't throw a slider like him or grow a mustache like him.
Yeah, what a
Great
mustache.
And he still has great hair, too. And probably still could throw in the mid-'80s if he was pitching today. But so we'll try to have him on every show because he's inspirational. Yeah, I agree with Susie Orman. I would say that number's actually higher than 95%. I've gone on rants about this before. With all the things we teach kids in school, and most of them are important, I think one of the more important things is finances and money, what a checking account is, what a stock is, what a mutual fund is, why a 401k is important. And I think it's a disservice, especially at a time when we don't have pensions. Most people don't get them. Telling them early to save for retirement and what are the options and what is an index fund. All of this stuff should be taught, and it's not. I'm an economist with an MBA in finance, and my family never asked me for financial advice. I don't know why. Economists are good at telling other people what to do. But all right, let's go around the room. What do you think, Lena? Is it 95% of Americans are financially higher or lower? What are you going with?
I'd say, I agree. It's got to be around 95. It seems high, but I feel like it's accurate.
Well, we'll send someone out in the street to say, what do you say, Ray? Higher or lower than 95? You can't just say 95. It's got to be.
I agree. Around there.
I feel like 90.
Sure.
Okay.
Sure.
Hannah?
I'm going to have to stand with my friends here.
Oh,
I agree.
come
I
on.
agree.
What?
Maybe even all right. Maybe even higher.
What?
Yeah. 95 seems a little low.
What a wimpy bunch of panel here we got here. Whatever happened to, like the McLaughlin group and all the fighting that used to go
We
on?
were clearly not given food.
See, that's why you need it. It's like that Aflac commercial. You don't have it, that's why you need it. But I'm not here to give financial advice, but I think it is, next to your health and your family, money's the next best thing. And I think the most important thing, and I think we're failing our children in school because we're not teaching that. All right, I think we got one more fun question for our panel here.
Yes. So Bankrate just conducted a survey where 92% of young people said they would give up other job perks for a 4-day work week.
So if you're wondering what these people said, 48% would work longer hours. 35% said they would change jobs or companies. 33% was interesting because this is all the rage now. They said they'd actually come into the office and work in person just to have that day off.
It's bold.
So now I got that commercial in my head. What would you do for a Klondike bar? We don't have money in the budget for cups, so there's no Klondike bars here.
It'd be nice, though.
Don't you love Klondike bars? Lena's like, I don't know what that is.
I love a Klondike bar.
Okay, well, then next time we'll have them. We got to have a refrigerator in the studio. Surprised Vince hasn't put one in yet. All right, we'll start with Hannah this time. What would you give up to work 4
Well, I
days a
did
week?
think about this for a little bit, and I stand with the majority on working longer hours each day. So I'd work 2 hours extra or 3 hours just to get that Friday off.
Well, you'd have to work at minimum 2 hours a day. I know people are going to say,
I could do it.
I do 2 hours worth of work in 20 minutes. And no, only I can work that fast. What do you got, Ray? What are you giving up?
Sweets.
You're too sweet, Ray. You can't give up sweets. Is there a perk you would trade for a 4-day work week?
No, because then on Monday it's just going to pile up.
I know.
To be honest.
That's what I tell my wife about
good
working
point.
on vacation. She's like, "Why are you checking emails? Because they're not going away."
Exactly.
Lena, what do you got? What are you giving up for Lent? I mean, what are you giving up for a 4-day work week?
I wouldn't mind coming into the office as I do now and then get to have a nice Friday of relaxation.
Okay. See, my answer is, I want to come in 5 days a week because I love my job and I love my office. And if you believe that, I'll tell you.
Thanks,
no, I'm just
Greg.
kidding. I had to be different. I don't know. It's funny how things have changed in the 31 years I've been working. It used to be you begged people to hire you and you did whatever they say. Now it's like, hold on, let's negotiate. I'll do this. It's almost like playing Monopoly. Like I'll give you Baltic and Mediterranean and $200 for Park Place or something. It's an insane amount. We think we're all professional athletes all of a sudden, and we can. I don't get it. Well, I guess we're done. So that's it for this week. I want to thank Hannah and Alex for helping with the blog, Lena and Ray for helping produce this. It's been a lot of fun for me to do it.
Me as well.
I'm not shy about voicing my mind, and
You're not.
And luckily, our crew here isn't either, and that's good. So it's been a lot of fun for me, and I want to thank our audience for tuning in. I hope you enjoyed it as much as we did, and I'm always excited to hear what you're thinking. You can email me at gheym@bhsusa.com, and that's Heym for those of you who don't know me. And, have your thoughts. If you have questions, we'll try to answer them if we can, if we have time. And we do have time. So I want a bonus because we still have 4 minutes left in our artificially, kind of self-contrived time limit we get. Sure, Ray, what is it?
What's going on with Bitcoin? Why is it going off the charts?
Well, I think the one thing about Bitcoin is nobody really understands what motivates it. It sounded like the great play against inflation because Bitcoin was sort of a separate thing. It was fixed and it was backed by something like dollars used to be backed by gold. So in times of inflation, that'd be a good place to put your money because you wouldn't lose it. And that proved to not be the case. So I think that it's completely volatile and I have no idea what moves it. I think there's a great adage in investing, if you can't understand it, don't buy it. And, I think that's something I tell people. If someone goes, well, somebody told me to buy this stock. Well, why? I don't know. They just said to buy it. Then don't buy it if you can't understand it. So I remember everybody was going to buy homes in Bitcoin and New York City was going to accept Bitcoin and Eric Adams took a paycheck in Bitcoin. And I don't. It seems like after the whole FTX thing that people are a little gun shy about that. It sounds a lot like the tech bubble to me, to be honest with you. But I'm not going to say it's whether or not it's a good. I think for anybody, I have to ask is just like with a home, is this right for me? Do I understand what the risks are, and then go forward. So, thanks for asking the first question. Maybe we'll call it Ray's question of the week.
I like that. Yeah, I like that.
Well, again, everybody have a great week, and let's go Jets. I want to see no more than 3 punts tonight because I saw enough to last the whole season last week.
And I second that.
Thanks, Hannah, someone's agreeing with me now. This is great. See you guys next week.